Good afternoon, everyone. Thank you for joining us for our fourth webinar in a series of 10 with Clive Lambert of FuturesTechs. Today we're looking at an introduction to candlestick charts. I know Clive's been looking forward to this one. He's a big fan of candlestick charts. Clive, are you there?
Hello, Chris. How are you doing?
Yeah, I'm good, thank you.
Excellent. Okay. Well,
Right,
yes, yeah, one of my favourite subjects, candlesticks, so hopefully that'll come across and we can give people something to think about to add on to what we've already looked at. So, I'll get cracking, and yes, so we're just going to go through a brief introduction to candlestick charts today. We're going to look at a little bit of the history, the construction, and then we're going to look at just one pattern today. We're going to look at the hammer pattern. But the reason why I do it like this, is because if we can understand the this one pattern, which is one of the most powerful, then we can basically get together the building blocks for every other pattern and every other, and just thinking about a candlestick, looking at the shape of it or a group of candlesticks and what that might mean. So ideally, today is the building blocks for having that understanding, and then being able to just look at any candlestick or group of candlesticks and say, well, what was that about then? And so yes, they've all got different names and stuff, but basically the names aren't as important as the message, if you like, that the different shaped candlesticks give you. Candlesticks have only been popular in our part of the world for the last 30 or so years. It's not a passing fad though, and they do seem to have taken over from bar charts as the go-to the go-to chart type, if you like. The psychology behind candles has been used by Japanese traders as far back as the 1700s, and an interesting aside to that is that one of the original sort of person who's sort of known to be, if you like, the godfather of candlesticks, whatever you want to call it, was a trader called Muneshi Homma. And Homma was a rice trader in the Dojima rice exchange back in the 1700s, and was such a successful and revered person that he was elevated to samurai status. So the samurai trader, if you like, the first and last maybe. And that was using the concept of actually looking at price instead of maybe the fundamentals when it comes to trying to work out make projections and understanding trading the markets, if you like. Charts similar to those that we see today probably came into use in the late 1800s with the candlesticks in the format that we see them now. And the Japanese did a very good job of keeping this quiet. And it wasn't probably until about the mid-1980s that a chap called Steve Nissen, who was at the time technical analyst for Merrill Lynch in New York, sort of went to Japan on a trip, saw people using these different looking charts that he'd never seen before, because we were all using bar charts in the Western world until that point. Got interested in the whole thing. Around the same time, there was a chap in the UK called Mike Feeney who was also did a similar thing. And so Steve Nissen was very much sort of has made a decent career since then out of being the guy who discovered candlesticks. But I think as a patriotic Brit, I'm happy to say that the flag was also being waved by Mike Feeney here in the UK, a gentleman who I was very lucky to meet and ask a few questions about the subject. In 2009, so Steve Nissen wrote a book. It's called Japanese Candlestick Charting Techniques. That's what it looks like. That's the top right. Is if you like, the Bible for candlestick charts, and it's a book that is my copy of it is extremely well thumbed. Let's say it's been that was my one of the key textbooks for me on technical analysis in my learning process many years back. In 2009, or 2008, I was asked to write a book myself on the subject, and that was published in 2009, Candlestick Charts, an introduction to using Candlestick Charts, and that's available at all good bookshops. It is, what should I say about my book? It's cheaper than Mr. Nissen's, and it's in colour, so, but as I've already said, the Nissen book is probably the Bible, if you like. So you choose which one if you want to do some further reading on the subject. I'll leave it up to you to decide which one you would prefer to peruse, as it were. So yeah, we use it. Basically, candlestick charts use the same data as your traditional Western bar chart. So what's the attraction? Well, the attraction is that you've got this color scheme, and I think even just a briefest of glances instantly gives you a clue as to how they can aid you in looking at charts. It gives you just that the color scheme, the color aspect of it instantly sort of gives your brain extra information, if you like. That's what a bar chart looks like. And we know this from the previous webinars, which is just open, high, low, close represented on that chart there, and that's a black and white version. Here is our candlestick chart using a green candles for when the market's going up and red for when the market's going down. And we'll go into that aspect, the color scheme, a little bit more now, because there's two different types of candlestick. On the left-hand side, we have an open, or let's actually just go on to the next slide, because it's the same thing, but we're using, it shows us using the color scheme that is generally accepted now in the Western world and on a lot of charting systems, most of the charting systems that you'll come across. So here we have a green candlestick. Okay, that bit in the middle is the difference between the open and the close of the day, and we'll just talk about candlesticks with respect to on the dailies for now. We will see, and we will look at charts of intraday, maybe even weekly candlesticks as we go through the presentation. But let's just think about them on a daily basis at the moment. This candlestick here means that we opened at this price. We then traded down to a low, to this low here, then rallied up to here, to this high, and then we closed here, and we closed above where we opened. So that bit in the middle there is green. If we open here, traded up to this high, traded down to a low here, and then closed here, so this right hand side candle is a filled candle, or black or red, red on the color scheme we're using today, and that means we closed below where we opened, and that is a red candle. So that's the simple construction of the candlesticks, and it's important to differentiate this from what you may see on quote boards, or what you may see if you're looking at a quote board that says where markets are, because you could actually have a red candlestick on a market that is still up on the day. Say something opens dramatically higher today compared to where it did yesterday, and then sells off through the course of today, but still closes above yesterday's close. So it would still be up on the day. But if we opened very high and then sold off through the course of the day, we would have a red candle. So the color of the candlestick is not dependent on where we are compared to yesterday's close. It is dependent on where we are compared to where we opened, and that's an important differentiation to make. Terminology wise, that bit in the middle, whatever the color of it is called the real body of the candlestick, and the difference between the top of the real body and the high of the day is called the upper shadow, and the difference between the bottom of the real body and the low of the day is called the lower shadow. And people sometimes call these wicks because we're talking about candlesticks, but the actual sort of ancient Japanese terminology is shadows. And as we go through the talk today, I will be talking about small real bodies, large real bodies, long upper shadows, things like that, long lower shadows actually in the case of the hammer. And so it's important to get that terminology straight in your mind, and hopefully everybody's au fait with that. Probably are anyway, because as I say, unlike 30 years ago, I think most people have a pretty good skill on everything I've said already with respect to the how a candlestick is constructed. Worth going through anyway. So it's a graphical representation of the psychology of the market, and it's important to think of it in that way. You know, we talk about the markets. Most technical analysts talk about the markets we try and personalize the markets, if you like, into two groups, if you like, the bulls and the bears. Okay, and you know, I think I've spoken to you about this in previous webinars. This sort of personalization, which allows technical analysts to sort of I think it just makes what we do slightly more interesting, to sort of talk about this the market as being an eternal struggle, if you like, between bulls and bears. You've got the bulls who are, you know, trying to push the market higher, who think the market's going up, and if the market does go up, then they're winning the battle, if you like. You may be in a rising market, but the candles and the candlesticks will be one of the first things that would tell you in a rising market generally whether there is a change in that balance between bulls and bears going on, and whether, if you're in an uptrend, the bulls are in charge, or whether the bears are starting to emerge from the sidelines, whether the sellers are starting to be heard, if you like. And then vice versa, if you're in a downtrend, are we strongly bearish and are the bears still running the show, or are they running out of steam and finding it hard to continue with their relentless selling? Or a few people jumping ship and turning over to the other side and buying the market? And so that's, you know, that's what we want to know from our charts. And obviously then you work to translate that into your trading. And clearly the easiest way to try and to trade the markets is by following the trend and not batting against the trend, if you like. My analogy for that is which way do you want to walk across London Bridge at 8 o'clock in the morning? Do you want to walk, you know, and London Bridge has a train station on one side and the city on the other side. So at 8 o'clock in the morning, you've got most of the people walking towards the city from the station. Do you want to be walking with the crowd, or do you want to be trying to go against the crowd? It's obviously much easier to walk with the crowd, and that's an analogy that I think can work quite well to give an understanding that actually it's easier to trade in line with the trend rather than against the trend, and the candlesticks can be the thing that can tell you what that trend is and whether it is changing, basically, and that can be on a minute by minute basis, or a day by day, or week by week. So that's what candlesticks are there. That's what any chart's there to try and offer us, is and to provide for us is that market colour and whether there is any change in the sentiment. And even just the shape of a candlestick on its own can give you an indication of sentiment, if you like, bullish or bearish or otherwise. Got three candlesticks here on this particular slide. Here we have a candlestick that has no real body at all. If you look, we've opened and closed, so that means we've opened and closed at exactly the same price. And that is a pure doji candlestick, okay? And a doji represents indecision. The market traded up to here, it traded down to here, it was confused, it ended up right back where it started. Now, if you have a day that is a doji, then that what that's telling you is that the balance between buyers and sellers was even. You know, nobody won, if you like. There was no winner in this battle between bulls and bears on that day. Whereas these candles over to the right hand side are the opposite, where there's no upper shadow there and there's no lower shadow. It's just, that's just one big black or red splodge. It's all real body, and that's known as a Marabuzo candlestick. And Marabuzo, I am reliably informed by Japanese colleagues, is roughly translated as shaven head. So we have nothing above or below, and that's a pure Marabuzo candlestick again. And what that says to you is, if you think about what happened on this day, the first price was the highest price, and we just sold off right from the start, and we kept selling off right until the close. And so the only reason why the market didn't go down any lower was because it closed, and it was like, come on, you know, come back tomorrow and you can do some more selling if you like. And that's the that's the idea behind a Marabuzo candlestick. It's showing conviction. This one is showing conviction from the bear camp, and this one is showing bullish conviction, where the market just traded higher all day throughout the day, right from the very off, basically. And they're known as Marubozu candlesticks. And we'll look a little bit more at those at the tail end of next week's webinar, in fact, because there's something interesting to take from those sort of days, apart from the obvious fact that they're strong. There's a strong trend going on. So yeah, candlesticks with small real bodies are the result of a session where the market opened and closed at similar prices, whereas large bodied candlesticks are formed when the market closes a long way from the opening price and just moves in one direction over the course of the day. Remember, the real body is just a representation of the difference between the open and the close. And Doji candlesticks can be a signal of a reversal in a trend, and here we have the DAX chart from a few weeks back. I think this was a similar chart to what I was showing last week when we were looking at support and resistance, and I've highlighted in this box here is a bigger version of what we saw a couple of weeks back in the DAX, and yes, we were posting these green candles, and the market was trading steadily, nicely higher, making new all-time highs, and then suddenly we had 3 days in a row. This is a daily chart, 3 days in a row of doji candlesticks, of complete, the market just stopped, basically. The scales tipped to even, and then the scales tipped over to red candles, and the sellers took over for a few weeks there. In fact, if we were to update this chart to now, we'd see that this blue area of support that I'd highlighted is indeed where we've found buyers, and we're sort of tipping back again and coming back. I mean, the DAX as we speak is at 13,150, so we're sort of around this area now here, having been down to this area of support here. So the doji candlesticks on that chart were the signal of a market balancing, and then we saw the red candles as the market fell over and the sellers got busy for a few weeks. A doji candlestick can be a reversal in a falling market as well, as we can see on this particular chart here. There is a couple of doji candlesticks, and interestingly they appeared, if we look back to the left hand side, they appeared at a support level where we'd previously posted this candlestick only a few months earlier. So doji candlesticks are reversal candlesticks. But this is one of my old favourite charts. I've got 2 or 3 charts that I just keep on my all my presentations, and this goes back to 2003. The reason why I keep it, is not because I haven't found any examples from recent times, but it just they do the job perfectly. So here we have an example, because actually what I want to show you with this chart is that the doji candlesticks on this chart did not appear at the absolute highs and lows. And I think it's important maybe to think about candlesticks not so much, you can use them as definitive reversal patterns, but I prefer to think of them as a sort of a day-to-day gauge of market sentiment. And because it's very easy to get yourself carried away with a particular trade, like equities are going up and they're going to go up forever, and that's the end of that. I've seen people do this in things like gold and Nasdaq and Bitcoin and stuff like that. And sometimes actually markets do top out and reverse, and we need to be wary of that, and we need something to temper our fear and greed that kicks in on any in our brains, and it's a natural thing. I'm not calling you all greedy and fearful. It's in all of us, and it's very unavoidable almost to have these biases. But something like a candlestick chart can allow you to temper those biases, or to allow you to sort of have a different view. And if this market, with this market that was going up, if when you'd seen that doji candlestick, gone, okay, I'm open to the idea, if you like, that the market may be topping out, then 3 or 4 days later, when we suddenly made a new high there for this move, and that was the first time. This is a bit of history here. This is the first time the Dow hit 9,000, and I remember, we all remember these sort of what's the word? You know, these milestone days. You know, and there's the sort of thing about having caps on the New York Stock Exchange and T-shirts saying Dow 9,000. And I'm sure that newspapers would have been screaming that day that the Dow's hit 9,000, and everyone would have got rather excited. That was the day. Look at it, big red candle, big nasty sell-off basically. And so yeah, we may have hit this significant round number. But actually, looking at the candlestick, it was a rather nasty day, wasn't it? And we'd had some pre-warning because we'd had that doji there. And actually, the market sold off 800 points from there, which is quite significant, you know, getting on for 10% pullback within the next month or so in this particular occasion. And then we got a doji candlestick, and we were thinking, oh, okay, maybe there's going to be a, you know, maybe we'll see the buyers returning. But it took a couple of days before that happened. Another doji there, and you're thinking, oh, okay, is that running out of steam again? The next day, it did. You know, it made a new high, but another red candle. And so, the point of this chart, and the reason why I keep it, is to sort of just have you open to the idea of, instead of actually using candlesticks just as a definitive signal generator, tell me when to buy, tell me when to sell, because you know, that can be pretty dangerous, if you like. You can use them just as a day-to-day guide of the market sentiment, if you like, and they may do you a favour in you know, if you do that and you allow them to give you sort of a flexibility of thought, if you like, okay, rather than just thinking this is only ever going one way, sort of thing. There are a few rather wonderful sounding hybrids of doji candlesticks, and one of my favourites is the gravestone doji. Why is it one of my favourites? Well, because obviously we have a rather emotive name there, if you like, and there are a few candlestick patterns where the name just in itself leaves you in very little doubt as to whether this is a bullish or a bearish pattern. And you know, the gravestone doji is one of those. If you see a candlestick shaped like this in a rising market, doji with an open and close right at the bottom, then that's a gravestone doji, and that's about as nasty a doji as you can get. And we saw one of these just a few days back in the, or on Monday I think it was. That's a 30-minute chart for the euro against the US dollar, and we started Monday with a very strong move higher. And then we posted that, a gravestone doji, and that was the high on that day. We gave it all the way back again. So that's the sort of thing we want to be looking out for. The opposite pattern to the gravestone doji is the maybe not so emotive dragonfly or umbrella doji, and that's that would be the opposite if we're in a falling market, or if we're coming into support and you see a candlestick with a with the you know, with the open close at the top of the thing. That is a dragonfly doji. There's a long-legged doji is another phrase for a candlestick that is you know, that has very long lower and upper shadows, but is actually a doji as well. So it's another one to look out for. So yeah, there's an example of a dragonfly doji just after a pullback that came into support, which is something again that we can talk about a bit later. So there's lots of patterns in candlestick analysis. Some signal a reversal, some signal a continuation of the trend. We've already looked at maybe the strongest continuation candlestick, which is our Marubozu candle. And we've looked at an example of a reversal, which is our doji candlestick. So today I'm going to spend the rest of our time looking at this little baby here, which is the hammer candlestick, and is, as I said right at the start, one of the more powerful reversal candlesticks. And every candlestick has a set of rules, and with respect to the hammer, here are the rules. A hammer has a small real body, so it's almost doji-like anyway because it has a small real body. That is grey because it doesn't matter about the colour, and we'll look at that a little bit later. For a hammer, the real body is at the top end of the day's range, which means there's very little or maybe even no upper shadow. So it's up here. Okay, what that leaves us with is a long lower shadow. Okay, and that should be at least twice the length or twice the height, if you like, of the real body. Okay, so actually, you know, that works out quite nicely. We've got something that looks a bit like a hammer, don't we? You know, we have the hammerhead here and the handle down here. Our fourth rule, very important to remember, is that this is a candlestick that you are looking out for, and it is a potent reversal if it is seen during a downtrend. Number 4 is very important. It's all about where you see these patterns as well as to whether they are, you know, because if you see that in the middle of a range, then what is there to reverse? This is a reversal candlestick. You need a downtrend to reverse, if you like. And that's the sort of thing we're looking at. That was the low back in July on gold, and that was a hammer candlestick down at $1,200, which is interesting because that's like a psychological level as well, one of those round number levels. And yeah, that's that hammer candlestick. Small real body, a long lower shadow, and yes, the market has been selling off before it appeared. And yes, that did give us the low because we did rally sharply after that. So, why is a candlestick that is shaped like this with this small real body and this long lower shadow? Why is that a reversal? What is the, you know, what's the sort of reasoning behind that, if you like? And the best way to try and explain that, or to you know to look at that, is to actually zero in on that day and look at the price action over the course of the day, and to think about the psychology behind each pattern. Okay, and think about the bulls and the bears as two groups of traders, and think about what they're you know, what they're thinking and how they're feeling, if you like, about their positions as this day unfolds. And let's think about it. This is what has to happen. This is what happened on that day in gold. We opened here, traded up to here, down to here, rallied to here, then came all the way back to here, and then rallied back into the close and closed here. To get the daily candlestick, which is here on the right hand side, to get our daily candlestick, all we actually need to know is what was the open that day, what was the low, what was the high, what was the close. And to get a candlestick with a small real body and a long lower shadow, the low has to be significantly lower than the open, the high, and the close. In other words, we've got this V-shaped direction of travel. Now we can see that actually the reality was it was very choppy in afternoon trade, but we did importantly close strongly. Okay, and we closed a long way from the lowest price that we'd seen during the day. So let's translate that into the thought patterns of the bulls and the bears. And if I'm doing this in a classroom, I usually sort of put an imaginary line down the middle, and I tell the left-hand side that they're the bears, and I tell the right-hand side that they're the bulls. And I want you to think about how you're feeling as this day progresses, and you know, and going into this day. Remember, we're in a downtrend. So the bears, the sellers, are happy. They're making money, or and you know, on their short positions, and they want the market to continue going lower. And if it keeps going lower, then they're going to make even more money, and they're happy. Yeah. And so nobody, especially on that side of the fence, is surprised when we see this sell-off here. They're like, yeah, well, you know, P&L's going up, and we're still going, you know, the market's going down, my P&L's going up. Nothing to see here. Happy days. But then this happens. We see its reaction higher for whatever reason, and the market rallies, and we close back near the highs of the day. What are those same bears thinking when they go home at the end of that day? Their P&Ls, their profit and loss accounts are diminished compared to what they were when the market was down here. If they've held onto a position all day, then they're going to be thinking, hang on a minute, I was making a lot more money this morning than I ended up with this afternoon, and so there's doubt suddenly creeping into their minds. The bull camp, the buyers, they start the day off just being smashed up again and losing even more money, because that's what that's what's been happening lately. We're in a downtrend, and they're long, so they're losing money. They go home at the end of this day actually thinking, oh, well, that wasn't as bad as it was first thing this morning. Actually, the market has made quite a solid recovery. Thank goodness for that. And so that's one way to personalize it and to think about this sort of, the thought processes of our two different groups. Is at the end of the hammer day, maybe there's been a change of thinking from both groups, if you like, towards what's been going on in the market. And that's everything that I just said to you, basically. It's a big change from what's gone on before, and suggests that the market has found support. So this long lower shadow on our candlestick says buyer's return, or bounce bought, dip bought. It's all of those things. It's saying that this is the moment where we've seen a shift in sentiment, where the buyers stepped back into the market. And yes, that was a good one on gold back in July. We rallied $160 in 2 months after that in gold. And here we go with another one of my my oldie but goodie charts, if you like. This is a weekly chart for the euro against the US dollar, and this is going back to 2000 and 2001, in fact. And again, I keep this chart for one very important reason, and that is that we've got two absolutely wonderful examples of hammers on that chart on the lows. Ha, only kidding. Well, we have, but that's not the main reason why I'm showing you this chart. It's actually almost the opposite. I didn't have to, drag out a chart from 17 years ago to show you a couple of wonderful examples of hammer candlesticks. We have seen them since, but actually, the reason why I stick to using this chart is because there's more than two hammers on that chart. And where are the other ones, basically? And so again, if I was in a sort of a classroom situation here, particularly with a smaller crowd, I find that when you get a big crowd, people don't like to pipe up. But if I have a small group that I'm standing in front of and talking candlesticks with, I would encourage them at this moment to point out on the chart where the other hammer candles are. As we're sort of doing this remotely, I will go through with you the particular candles that people point out. This one here gets quite a lot of mention. Yes, it has a small real body and a long lower shadow, but is it a hammer? The answer is no, because we're in a rising market when it appears. This one here again gets some attention. Small real body, long lower shadow. It's the right shape, but again, are we in a downtrend? Are we in a falling market? Only just, and the last couple of candles were actually green, so again, I wouldn't be calling that a hammer because of where it is. This one debate often rages about. We are off the highs, but it's the right shape again, small real body, long lower shadow. But again, I wouldn't class that as a hammer because we're just off the highs rather than actually in a falling market. So where are these? Then there's two hammers. There are still another two hammers on this chart apart from our two down here that I put in inverted commas that worked. So where are they? I'll tell you where they are. They're right here. Those two there. This one and this one are both of those candlesticks are hammers. Small real body, long lower shadow. This is an even better example. Small real body, long lower shadow. So why am I pointing these out to you? Well, I can tell you why. Because you only ever see the candle. This is the last candle on this chart that we know about. Everything that comes afterwards is, it does come afterwards. So when you would have seen these hammers, you may have been thinking, right, okay, that's the reversal. Market's going to go up next week. And if you had if you like, if you'd have set up a fund and said, or a trading system that says every time I see a hammer, on the weekly, I'm going to buy the market, okay? Then you would be out of the game on the first trade here, because that big red candle there negated any hope, if you like, that those hammers offered to us, and actually just you know, there was no reversal at all. Yes, we saw a reversal here after that one, and we saw a reversal here after that one. So what's the point I'm trying to make? Well, there's 2 points I'm trying to make, really. One is that you probably shouldn't have a trading system that is just based on one particular aspect, and certainly with candlesticks, you need to wait for confirmation. You need to wait to see that the market follows through with the message that the candlestick is suggesting. And it's at this point that I say to people, right, okay, what can we do just with what's on that chart there? Let's not use any other information just for now, just to keep it simple, and while we're sort of doing the theory, if you like. What can we ask for with respect to that word confirmation? And so usually somebody is sitting in the audience and says to me, how about a green candlestick afterwards? And so we'll run with that, and we'll look at the idea of, we've got a hammer candlestick. We're going to ask for the next candlestick to be green, and if we've got that combination, then we shall go long. Okay, so let's do that here. There's a hammer, there is a green candlestick. Okay, let's go long. So you would buy at the start of this candlestick, at the start of this week. It's a weekly chart, so this week here, and that surely would have been a winning trade. I think it's very difficult, hopefully, to have lost money on that trade. That is a winner, if you like. Let's do it with this one. Okay. Right, we've seen a hammer. We've got a green candlestick. Okay, let's buy. Okay, we buy here at the start of this week. What unfolds is a 3-week sell-off, and I think Sod's law says you stop yourself out somewhere around here and then watch it go like that. That's probably you know, that's what they call Sod's law, if you like. But that would have probably, to be fair, using our system, been a losing trade. As long as you have a tight stop on it, then hopefully you haven't lost too much, and you would have made a lot more money on this one than you would have lost on this one. But more importantly is on this one here, if you'd have said, right, okay, if we see a green candle, then I'm going to buy, you did not buy. There was no trade triggered by adding our one extra layer of confirmation. And again, when the next week came along and we saw a long lower shadow and a hammer candlestick, we would have asked, okay, for the next week to be green, and then we'll buy it. And again, we did not get that confirmation signal, so we did not get long, and the market sold off, and we stayed out of a bad trade. And I think that this is making quite an important point about technical analysis and about the idea of using charts to trade, because it's as important. And if you read a book like Market Wizards, which is one, I think I did suggest this on my recommended reading list. I think I've been through a few books early doors, didn't I? I think I talked about Market Wizards, Jack Schwager, interviews with top traders. One of the things that that seems to be a recurring theme when I've read that book over and over again, as I have, is that the best traders in the world, all these really good traders, their main mantra, one of their key mantras, is don't lose money, or if you're going to lose money, only lose a bit, but stay out of bad trades and try and run good trades and make as much money as you can out of good trades. But if it's a bad trade, then get out quickly, or even better, don't even get into bad trades in the first place. Have a robust system. And so here we have 4 hammers on the chart. One would have made us money, one would have lost money, but hopefully not too much, and 2, we would never have triggered the trade in the first place. And that's the point I'm making, is that just by having that extra little thing in our system, we are saying that we're staying out of a bad trade. Okay, so hopefully, you know, but then there are other things you can use. There are other overlays, and we're on week 4 now of 10, and as we go through the weeks, we will be adding extra methodologies into the equation, so that at some point, by the end of this, hopefully, you will be sitting there going, I quite like that, and I like that, and you'll be cherry picking things that sort of work for you, that can work together to give you, to allow you to use the charts to good effect for your trading and your decision-making process. One of those things might be a momentum study like slow stochastics, and in fact, if you'd have put slow stochastics on the on that particular chart as an extra filter, then that would have said to you, don't touch it here, but it would have said to you, yes, it's in, here and here it would have said, yes, this is an interesting trade. But again, we can look at that a little bit later on in later weeks when we actually look at these momentum studies. Here's a series of slides that the first one's not actually that clear, but again is a 10-minute chart. Okay, this is a 10-minute chart, and we talked about gaps last week. Do you remember how we talked about gaps that form resistance levels? Okay, and this is a 10-minute chart, and there was the low, or yesterday if you like, and then here is today's, or in inverted commas, today's opening trade. We gapped lower, we got up to the gap and we fell over. We came down again, we made a new low, and we posted a hammer there on the 10-minute chart. It's not that clear, but you'll see why it's not that clear in a minute. If you saw that hammer, would you buy the market? And the answer that I'm suggesting is no. You wait, because you've still got this resistance here that could weigh. Okay, if you buy it here, then it could just get to here again and sell off and fall over. Wait for the resistance level to be cleared, and then that's confirming. That's the confirmation of that hammer candlestick, and sure enough, the market flew higher after we saw that. This is the same price action on a 30-minute chart. Okay, so this is the 10-minute chart. That's the same price as, but on a 30-minute chart, and we can see we've got one of those umbrella doji that we talked about, which is also a hammer because it's a small real body and a long lower shadow, and there's no up shadow at all. But again, that resistance level, that horizontal line, that gap is still in the same place. Doesn't matter what time frame. 60-minute chart, same thing, hammer candlestick, but still got the resistance there. And we still, whatever time frame we're looking at out of these three, we see the reversal pattern. And yeah, sometimes I say to people that if I see a candlestick reversal pattern, the first thing I do is absolutely nothing. Okay, the first thing you do actually is not nothing. You look higher. If it's a hammer, if you see a hammer, look higher and say, where do we need to get above to confirm this? And if there's a natural, obvious resistance level like this one here, then you've got your answer very quickly, and you've got that sort of extra layer, that confirmation, if you like, that okay, that's what I want to see the market doing to confirm that reversal. So in that instance, we had a strong reversal pattern on 3 different short-term time frame charts, and that would boost confidence that we've seen a bottom, but that resistance was the same whatever the time frame. And the important message is wait for the resistance to be taken out, ideally with a uptick in volume or volatility, to say yes, the bottom is in. Whatever the time frame of a chart, the message was the same. We've just seen a sell-off and a recovery. A hammer is the result of a V-shaped direction of travel, of a sell-off followed by a recovery. And the candlestick's just merely mapping what's just happened. If it's happening, if it's giving you the same message across a number of different time frames, then that increases the strength of the argument. But yes, that is indeed what's happened, because different time frame traders will all be thinking the same thing, or we've got downside rejection, whatever the time frame you're looking at. So it becomes more compelling, if you like. A common question I've asked, and we've not had any questions so far today, which is rather unusual, but that must mean that I'm doing my job efficiently, or I'm at least hoping that's the case. Does it matter about the colour of the real body for a hammer candlestick? Okay, and there we have an open or a white or green real body there, and there we have a black or a red or filled real body. And if we think about what happened in either of those cases, then the answer really becomes pretty clearly, no, it doesn't matter about the colour of the real body. It's a small real body anyway. Maybe a green or white or an open real body has a little bit more significance because we closed above where we opened. But no, in general, in my experience, the colour of the real body doesn't matter so much. And so it's very much about how long that lower shadow is, because that's how far we went down and then got it all back again, if you like. So yeah, that would be my simple answer to that question. Does it matter about the colour of the real body? No, not in my experience. And so that is the end of my ramblings for today. And so I would invite any questions people may have, or maybe we can look at some live charts if you like. Please do give us a shout if you have anything, any questions you got or anything you'd like to look at. The chart that I've just displayed on the screen is for is something I'm watching today, which is the dollar CAD, US dollar against the Canadian dollar, and that's been in a rising trend lately, and we've been holding and we're forming a nice uptrend line there. So I'm looking to buy dips in that. That's been one of my things that I'm keeping an eye on today. A trade in line with the trend, buying a dip to that downtrend line, which is around 127.50 on dollar CAD. So I'd be looking to try and buy above there, and looking for a return to this high here at just above 129, and then we've got another Fibonacci level up here at 132, which is an interesting level for me on a 1 to 2 week swing trade on dollar CAD. What's your vision on the DAX for this week after we broke 13,100? Let's see if I've got a DAX chart that we can display. Here is the DAX. What's that? That's a 30-minute chart. 30-minute chart for the DAX. This is interesting. This was Monday morning. Look, there's a really nice hammer there. And if we close this chart up, we can see that that hammer appeared around the support levels from last week. There's a market that was falling. There's a low. There's a high. There's a low very similar to that one, and so what I've been keeping an eye on in the DAX is that level there. Ooh, come here, you. Because a break above there would give us what? A double bottom buy signal, and we've done that. We've done that in the last this morning, and we've seen a reaction. Okay, that was at 13,093. We've since rallied 80 points. The DAX is looking very strong all of a sudden again. If we revert to the daily for the DAX, I wonder if I've got any I haven't got any of my drawings on that particular chart, but we can see that the come here you, where's that? All right, yes, here we go, Fibonacci retracements. I think this was the chart that I looked at on the webinar that I had last week. I don't like the way this does these colours. I always fade the colours a little bit just to try, where is it, background, to get rid of that. Okay, 38.2% of the rally that we saw from what was that? That was the end of August up until that high in at the beginning of November is 12,900. Okay, and that was, yeah, that's where there was support there. That was what that orange blob was on the slides that I showed you last week, and we dipped through here a couple of times and found buyers. So that now looks very strong to me. And if we were to go to something like a 4-hourly chart, then we can, there's the double bottom looks quite clear on there, doesn't it? And again, if we do a bit of a Fibonacci thing on that, we can find some upside targets. Okay, there is where I'm going. You go there. Okay, the DAX likes a 61.8% retracement. It always has. So 13,270 is a target for me. And then I think we go to here, 13,325. If we can clear 13,271, and then back to the highs, and that all looks like we've sort of a rescue job has happened again, if you like, on that market. And as we speak, US markets are, you know, they tried to go lower last week, but again the dip buyers came in, and this continued theme that we've seen, it seems like years now on equity markets, where the dips get bought just as things are starting to look precarious, it's happening again. And you know, there are a few things around that are saying to me, this is not going to last, this is going to turn over, but the trend continues to you know, to be higher, and we continue to set higher highs and higher lows, especially in US markets. And so that you know, that day, if you look at something like a weekly chart, you know, it's very clear that the trend is still pretty, very strong to the upside, basically. Any other questions at all, people? Any other markets you want me to look at briefly? No change of head and shoulders in the DAX, or no chance. Let's have a look. I don't think there is. There's our. It's too early to say, really, and also, you know, so you're saying that is this a head and shoulders? Is that a shoulder there, a head there, and a shoulder here? Well, at the moment we're a long way off from that happening. You know, that we would need the market to top out somewhere soon around here, and then sell off through that low. And also, you know, where's the neckline on this pattern? The neckline is something like there. Okay, so we'd actually get the sell signal from the head and shoulders after we broke this low here, because it's a downsloping neckline. So this is the sort of thing where it's, you know, it does look a bit like it might be a head and shoulders, but I'm not going to get excited about that idea yet, because we haven't, you know, we're just heading higher again at the moment. So too early to say.
Clive?
Yes, sir.
Thank you very much.
Okay, yep, been a pleasure, and hopefully we've added a bit more colour.
I think
another methodology.
And we've got through all the questions.
Okay, excellent stuff.
So next week we've got what have we got next
more
week?
Candlesticks. We're going to look at some more patterns. More patterns.
Can't wait.
Okay, excellent stuff. Well, thanks very much for listening, everybody.
Thank you so much for everyone attending. Clive, thank you very much for your time, and hopefully we'll catch you all again same time next week for part 2 of Candlesticks. Thanks, Clive.
Cheers. Bye bye.
Bye bye.